In recent days, some of you have asked me, why is the Australian dollar so strong? From a level of 65 US cents at the end of July 29, the Aussie dollar had actually fallen down to a low of 55.08 cents in March. From that level, it rose rather dramatically to 70.65 cents in June. And at the time I'm talking to you, it's come off slightly to 69.3 cents. The answer to why the Australian dollar is so strong can be found by looking at flooding exchange rate theory. This is one of the few occasions in economics where what happens in practice is what you'd expect to happen in theory. What matters to a level of a flooding exchange rate in theory is determined by the relative level of prices in the two countries setting their exchange rate and the level of bond yields in each of those two countries. We can adjust the level of the nominal exchange rate, that's the exchange rate you see quoted every day, by the ratio between the two price levels. By adjusting the nominal exchange rate by the ratio of prices in both countries, we are able to calculate what is called the real exchange rate. The real exchange rate of the Australian dollar can expect to go up when Australian bond yields are rising relative to US bond yields. The Australian dollar can expect it to go down when US bond yields are rising relative to Australian bond yields. So what happened over the period of this financial year? Back at the end of July 2019, when the Australian dollar was trading at 68.5 US cents, Australian 10-year bond yields were yielding 118 basis points. And that was way below the yield on US Treasury bonds of 201 basis points. Australian 10-year bonds were yielding 83 basis points below US bonds. And in the next circumstance, we would expect the Aussie dollar to go down and the US dollar to go up. And that's exactly what happened. This process was accelerated when we got into the pandemic, which hit financial markets in March 2020. The flight to quality out of all international assets into the US dollar drove the US dollar up and the Australian dollar down. In response to the crisis, the US Federal Reserve made aggressive cuts in the Fed funds rate. The Federal Reserve database tells us that the effective Fed funds rate fell from 240 basis points at the end of July 2019 to 5 basis points. That's 5/100th of 1% in March 2020. And it has remained at that level ever since. The result was that US 10-year bond yields then fell dramatically from 201 basis points at the end of July 2019 to 65 basis points at the end of March 2020. This was a decline of 136 basis points. Australian 10-year bond yields, on the other hand, fell from 118 basis points in July 2018 to 76 basis points on March 2020. This was a decline of only 43 basis points. Now, importantly, what had happened here is that US bond yields had fallen by 93 basis points relative to Australian yields. And this big move in relative interest rates, the relative interest rates on the two bond yields in favour of the Australian dollar, set up the rally that was to follow. As a result of this dramatic cut in US interest rates, the Australian dollar began to rise. Over the next month, Australian 10-year bond yields rose further and US bond yields fell further. And Australian bond yields rose by 14 basis points to 89 basis points. This means that Australian 10-year bond yields had risen by 108 basis points relative to US bond yields at the end of July 2020. This rise in the Australian dollar then began to accelerate. The larger difference between bond yields was the final factor driving up the Aussie dollar all the way up to 70.65 cents in June. Since that time, the difference in bond yields has declined slightly and the Aussie dollar's drifted down slightly. A model containing variables, including those that I've just been talking about, can explain 87% of monthly variation of the Aussie exchange rate. Fair value of such a model currently stands at 69 cents. It is possible for the Australian dollar to rise further and overshoot, but the rally caused by the drop in US interest rates is already fully absorbed by the price. So in conclusion, the rally in the Australian dollar between March and June 2020 demonstrates that sometimes things in economics can work exactly the same as they do in theory. Aggressive cuts in the Fed funds rate by the US Federal Reserve have led to a situation where US bond yields fell dramatically relative to Australian bond yields. This yield advantage then caused a rapid recovery in the Aussie dollar, which has occurred since March. That rally now seems to be followed by a pause.